So good afternoon and welcome everybody. I'm Alistair Pym, VP of Innovation and Entrepreneurship and Partnerships at NECEC, the Northeast Clean Energy Council. And we're really happy to welcome you to the fourth of our series of 5 webinars on investor and corporate partner readiness. We're trying something a little bit different today in that we're holding a webinar and also a sort of physical presence at the Urban Future Lab in Brooklyn, New York today. So we hope this brings the same content to more people, encourages more networking and more collaboration. So we'd love to hear your feedback on how it's worked. Today, we've got a great story about existing and evolving investment models in the clean tech ecosystem. And we also, at the end of that, we have some entrepreneurs pitching to the investors who are there in Brooklyn today. And we've got a great speaker lineup who I will start to introduce, and then John Santelleri, our moderator, will introduce the rest. But just first, let me run through the flow of the day and mention a few housekeeping issues. I hope you can all see the slides and that you're able to hear the speakers well. We are recording the webinar, and we'll share a link to the recording and the slides with everyone who's registered for the event after the event is over, probably tomorrow. And we'll post that on our YouTube channel site, where you can see not only this webinar, but also the other ones in the series too. Moving on to the second slide, I would like to thank, first of all, our host, the Urban Future Lab, which is part of NYU ACRE there in Brooklyn, for hosting the webinar down there, and being a great partner to NECEC and the rest of the clean tech ecosystem in the Northeast. So thank you, Pat and the team there. Secondly, I'd like to thank our sponsors, the Massachusetts Clean Energy Center and NYSERDA, the New York State Energy Research Development Authority. They both fund us to drive innovation and acceleration of the clean energy sector in the Northeast. Now, for NECEC, the Northeast includes New York and all 6 states of New England. And we realized that at incubators like the Urban Future Lab, you've got a great local network. But the point of NECEC is that we have an extensive network of investors, corporate partners and customers and professional service firms all the way across the Northeast. So we can expand that network for you. And we believe together, we've got everything that we believe a clean tech startup needs to help you start, grow, and scale your business in the Northeast. So let's have a look at the agenda. So when I finish, I'll hand over to John Santelleri, who's a principal at Stonework Capital and also part of the CEVG network in New York now, and an innovation advisor from NYSERDA. And thank you, John, for moderating and holding the fort down there today in Brooklyn. Then we'll have our investors speak and explain their organizations and sort of where they aim at and what they're looking for. And then John will host the sort of questions for the panel and carry that conversation on, but we'll also encourage members of the audience there in Brooklyn, but also remote audience online, to post your questions on chat so that we can widen out the questions. So at 2:30, we'll then switch gears and have the startups pitch, and we've got Empower Equity, Enviro Power Technologies, MediOviva, and Thermolift pitching, and there'll be an opportunity for the investors to give them some feedback, which will also be part of the webinar today. And then I'll come back right at the end and just wrap up. So with that, I think it's time to just remind you that we have put everyone on mute except me here and John and the team in Brooklyn, because we don't want to have any extraneous noise. But please use the Zoom chat to post your questions. John has an assistant there who's looking at those questions and making sure John can see them, and he will then choose the best questions to ask to the panel. When you make your questions, please address them to everyone so that we can be sure that the team there is seeing them. And then if there's any people in the room, please keep your cell phones on mute. Let's make sure that we have everyone can hear clearly everything that's going on. And I believe there's a mic there to pass around for questions. So at this point, I'd like to hand over to John Santaleri, who's a great member of NECEC. As I said, he's principal at Capital, advisor to NYSERDA, and part of the CEVG network. John, over to you.
Thanks very much, Alistair, and welcome to everybody out there on the interwebs to this webinar. And I'm very excited to have a great panel here today, really representing a broad range of investment styles as well as different strategies on both the funding side and the investment side, and not at all your typical investors. So I'd like to start with each of the investors introducing themselves and giving a few minutes of introduction on their firms, and maybe a couple of thoughts on the areas of particular interest that they have in terms of their investing targets. So with that, I will turn over to Ben and let you start.
Thanks, John, and thanks for having me here. My name is Ben Sampson. I'm an investment director with GE Ventures. I've got a couple of slides here to run through GE Ventures at a high level, what our mandate is, where we fit in the bigger GE organization, and then dive into some specifics on the investment side, what we're looking at in the energy space. So Alistair, I don't know if you're driving slides or...
I will go straight through to your slide.
Oh, sorry. I guess we're a little out of order. Perfect. So I'll take the next slide. So GE Ventures is really an innovation organization within GE, and we're a very externally facing part of GE, and we engage with a broad set of ecosystem players, which includes startups, other investors, governments, universities, accelerators, other customers of GE, potential partners for GE, the list goes on. We really bridge that gap of the external organizations within the ecosystems that we operate in, and the internal business units within GE. The next slide here has a couple of specifics on what we do within GE Ventures. Perfect. So I'll skip equity investing for now, because I'm going to get into a couple more details on that. But we've got a group called New Business Creation, which is really an internal incubator within GE. We're taking technology that comes from our research center or business model ideas that exist within their industrial businesses that are maybe too early or too small, frankly, to be built within a business unit. So we'll take them out of the business units. We'll put a management team around it. We'll treat it like a typical venture-backed sort of milestone-based funding model. Sometimes we'll take external capital. Sometimes we'll fund it wholly within GE, and then we'll exit those businesses. And an exit could be spinning it back into a GE business unit. It could be spinning it out via IPO, or it could be a trade sale. So that's one aspect of GE Ventures. Another is our technology licensing group, which is really focused on out-licensing technology that's developed at GE that we're not commercializing through in industrial businesses. We've got several examples of successful license agreements there. And lastly is market transformation. This is really GE's effort to take the internal scientists that we have within our research center and partner with external scientists at laboratories or universities to really make sure GE is working with the best scientists in various fields to make sure we're on top of the next game-changing technology that's maybe 10, 15 years out. So the next slide goes into a little more detail on equity investing, which I skipped in the previous slide. So the top here is just 6 themes that we invest in. Broadly, we invest in industrial technologies and healthcare. We've got about 25 investment professionals in the group investing up to $200 million a year. We have 100 active portfolio companies in 8 different countries. The bulk of those companies are in North America, roughly 3/4, I think. Another large bucket out of Israel, where we have an office in Tel Aviv, and then a sprinkling of a handful in Europe and other markets. We invest seed to growth, but I'd say our strike zone is Series B, Series C, early commercialization, revenue traction, most of the technology risk retired, really looking to solve market and execution risk. We've got offices all over the place in the US as well as Tel Aviv. So the next slide goes into themes in the energy space that we're looking at. I think I'm short on time, so I won't go into too much detail here, but we're really looking at electricity transformation. We're seeing the grid move from centralized to decentralized, digitized assets, and decarbonized assets. We see a lot of opportunity there. Application disruption is really looking beyond the grid at smart buildings, smart cities, IoT applications, industrial applications, as well as transportation and mobility. We have a group working on natural resource optimization, digital oil field technologies, production optimization, etc. And then the last bucket here is connected industrial technologies, which is really looking at enabling technologies that span across industrial businesses and aren't really a vertical solution, but could be applied to energy, to agriculture, to transportation, to manufacturing, supply chain. Really focusing on edge technologies, pushing intelligence to the edge. Yeah, and then the last slide I think here was just to show exemplary companies in our portfolio in these various buckets.
Terrific. So maybe we'll move on, and Ryan, ask you to, being mindful of time.
Sorry about that.
We do have time afterwards in our next section where we can come back to some of the slides that maybe we need to run through quickly.
Yeah, so thanks, John. My name is Ryan McPherson. I lead investment operations for a group called Prime Coalition. For those who may not know, Prime is a 501c3 public charity whose mission is to empower philanthropists with the tools and vehicles they need to mobilize their charitable capital into early stage market-based solutions to climate change. And so next slide there, Alistair. Prime was founded about 3 years ago now on the idea that many of these early stage companies were being underfinanced by traditional forms of capital, either because they were too capital intensive or the deployment timelines were a little too long and uncertain for some of the traditional financiers. And so in that regard, we serve as a financing intermediary in a sense, allowing your private foundations, corporate foundations, high net worth individuals, donor advised funds to be able to place their charitable capital into these really promising opportunities for mitigating climate change going in the future. And then next slide, and perhaps the next one after that, just in the interest of time. Over the last about 18 months, Prime has kind of quietly become one of the more active early stage investors in energy technologies because of this model. We've mobilized about $15 million across 6 different companies. Most of those are sweet spot, I would say, is Series A. We're certainly willing to take on much more technical risks than perhaps other investors might be able to. And the sort of metrics that we hold our feet to the fire is all around, are we bringing new forms of capital into this marketplace? We're not about trying to bottle old wine into new bottles. We're really interested in getting philanthropists who might not have realized that this is an issue, mobilized and engaged on change, or to get some first-time philanthropic investors who didn't even realize that they could use these vehicles to support early-stage companies. Next slide there, Alistair. My role within Prime is to lead our investment funnel process. So that's to start with the entire world of clean tech companies as we define it, and be able to down select those that we feel would be have the largest potential for impact and fit our thesis to be able to bring to the philanthropic community. We're really evaluating these companies across 3 primary criteria. One is around climate impact, which we define as 1 gigaton of carbon dioxide emissions reduction potential annually by 2050 when at scale. Another is around commercial attractiveness, which is sort of your sort of traditional investment criteria around market fit, team execution risk, and technology risk more generally. And then the third fit for charitable capital, which is a little bit more of a nuance for Prime as an institution, in that we are not trying to crowd out traditional financiers, but where can philanthropic capital have a unique and catalytic role to play in the evolution of a company. And so to the latter criteria, we have an investment committee of 12 of some of the most active early stage investors in clean energy technologies that help us articulate, yes, this is an interesting opportunity, but I couldn't invest in it using my traditional vehicle because of X, Y, or Z reason. Maybe the exit risk is too uncertain. Maybe there's just too much technology risk right now, and they'd like to see a demonstration or a paying customer. And whatever those reasons are, we can enumerate those and take it to the philanthropic community to say, hey, this is something that requires your capital, requires it today. So next slide there, Alistair. Just really quickly here, from an entrepreneur's perspective, there's a couple of vehicles that we can probably talk to a little bit more throughout this panel, but either if a financier or a philanthropist uses Prime as an intermediary, we issue a recoverable grant to the entrepreneur themselves that's subordinated to everything in your capital structure, or we serve as just a matchmaker in allowing the philanthropist to issue a convertible note or direct equity through a program-related investment to the entrepreneur. Next slide. And so those 6 deals that we talked about and 2 more in the pipeline right now for 2017, that's really on the syndicating philanthropic capital on a deal-by-deal basis. Prime is in the process of trying to scale that model through its own impact fund, with you're using purely charitable capital to be able to do this on a rolling basis and more companies. So that's our intro.
Excellent. So now I'm going to turn it over to Sasha Brown, and Sasha is here from Ecosystem Integrity Fund.
Good afternoon. So EIF is perhaps the most boring of the 3 in terms of our investment model, because we are a single bottom line venture capital investor, and our thesis just happens to be around sustainability. So jumping into our slides, the broad strokes overview of how we invest is we look to take significant stakes in early stage companies, not generally seed stage, but companies that have some demonstrated commercial traction, some amount of revenue that can range from hundreds of thousands to millions of dollars. But these are generally companies where the primary risk we're taking is scaling risk, and we're very active investors. We take large ownership stakes in part because we want to have a significant amount of influence and support the companies in whatever way they specifically need. The kinds of solutions we're looking for are business model innovations or technologies that are ready to go to market today to solve existing market problems. So maybe we'll skip forward on those slides to explain a little bit about how we look at those market problems. So one of the distinctions between us and some other early stage investors is that we're looking for incremental solutions. So our view of the world is that the reason we have entrenched environmental problems is because there are entrenched large systems, business systems, social systems, economic systems that support the way that things are today, and that there are opportunities as the macroeconomic, resource constraint, et cetera, factors begin to trend in different directions, that there are little niches within these large systems where more environmentally friendly technologies begin to have an edge, whether it's from consumer preference or just economics, usually in B2B situations, that there is an opportunity for a new business model or a new technology to solve a real market pressure. And so we're looking for those that are ready to go to market and those niches that are ready to change today. You want to skip forward a slide? We can probably, in the interest of time. A lot, the macro drivers for a lot of these include scarcity of natural resources, infrastructure that's aging, public environmental concerns, consumer preferences that want healthier, safer, non-toxic. We'll skip to the next one. Systems-based approach, I probably covered that enough already since I have 1 minute, I think.
I'll certainly come back to it.
Yeah, I don't want to beat it. So I think the biggest point I try to make when I describe kind of how we see the world has to do with we're not looking for moonshots. We're not looking for technologies that are in a lab that have the promise to revolutionize markets, because we think that the markets are generally quite slow to change. And so we're really looking for markets that are asking for a solution and solutions that fit that set. So with that, I will jump us into Q&A. And these are some of our, that is applied across really any part of the business system in a variety of different verticals where we've spent time. And if you peek at our portfolio, we've done everything from renewable energy developers to stormwater infrastructure to consumer products. And so it does get applied quite broadly.
Thanks very much, Sasha. So Alistair, I wonder if you could indulge me, and I got us off track right off the bat. I don't know if you're able to go backwards to the earlier slides on CEVG, but I'll just spend a moment introducing myself, John Santilleri, and I'm here, as Alistair said, wearing two hats today, both representing NYSERDA, where I'm an innovation advisor. I've been engaged for the last 8 months helping NYSERDA's research and development group, what they call technology and business innovation. And I've also, I'm very excited to announce that my firm, Stonework Capital, is now teamed up with CEVG out of Boston. You can skip to the next slide there, Alistair. And CEVG is an experienced clean tech angel group based out of Boston. I'm one of the founding members of a group in New York, an affiliate, expanding the footprint of CEVG. And what's exciting for me is that their investment philosophy is kind of described here on this page. It really lines up with my personal philosophy, you know, focused on clean tech and opportunities that have the potential to mitigate climate change, and investing in a very collaborative and active way with entrepreneurs. My background is that I spent 15 years at Warburg Pincus, where I was a generalist, but invested in a pretty broad range of deals, including some environmental related deals and a number of fintech related deals. And then over the last 10 years, ran my own impact oriented fund where we were active in clean tech, among other sectors. So it's exciting for me to join with CEVG and get the breadth of experience that their angel group has. And they also have a new development, which some of you may have heard about yesterday. CEVG has, somewhat uniquely for an angel group, successfully raised a institutional fund. So we now have committed capital sitting side by side with an angel network, which consists of, you know, a number of very experienced both operational and investor types. So I think that's an attractive combination to bring to investors. So Alistair, I wonder if you could skip ahead to the NYSERDA slides. So NYSERDA, I'll just touch on briefly. For those of you who don't know, you know, most people have heard of NYSERDA. The thing that surprises some of the folks that I talk to is the research and development group, what again called Technology and Business Innovation, on its own is a massive investor. They're investing $80 million a year through a combination of direct investing, support of incubators such as Acre here in Brooklyn, and proof of concept centers across the state. And this graphic shows some of those locations. That $80 million a year would put them, you know, among the top private or public supporters of clean tech in the country. And there's a number of great success stories. I think what we'll do is, rather than spend any more time on NYSERDA, I'd be happy to take questions or talk about it later. But let me shift gears and move to the Q&A section of our discussion. So Sasha mentioned something interesting. She talked about, you know, focusing on niches and aggregations of incremental solutions. I think we've seen in clean tech that, you know, a lot of the change has been incremental solutions, which, you know, when you scale them and you add them up, start to have material impacts. I wonder, Ben and Ryan, if you guys could comment on your firm's balance between a niche or incremental type solution versus a moonshot or a game-changing solution in terms of where you're targeting.
Sure, I'll kick it off. This is Ryan from Prime. Ours is purely the moonshots. So we are only looking to support companies that we feel are going to hit that greenhouse gas threshold that I mentioned before. And then to be able to do that, lots of times you need to be able to shake things up quite a bit from the status quo of where we're going right now. And because of that, and because of the form of capital that we're deploying here, we're able to take on that risk that others might not be able to. So I actually think this panel is a really good capture of the different types of capital that are looking to support early stage companies It's just our flavor is certainly focused in on making sure that we're supporting those types of organizations that, if they are successful, would drastically reduce the climate mitigation, the climate that's being, the carbon dioxide being emitted into our atmospheres.
Excellent. Thanks, Ryan.
Yeah, and GE is probably in the middle or straddling both here in terms of investing in moonshots and more sort of incremental advancements. We look at, you know, our strategic priorities within the company, and we look at investment opportunities on a deal by deal basis, and sometimes they are sort of closer to GE's core, where GE can help add value, and maybe there's a few milestones that company has to achieve to get market traction and get acquired in sort of, you know, the medium stage of a company, because it's important to an existing product either at GE or other industrials. That said, we don't have to invest in, we don't have a requirement that something has some relationship with GE, so we can also invest in, you know, a disruptive technology that could disrupt a GE business. You know, the GE has recognized that that's important to look out at what could disrupt you. And so we have you know, we are the external facing organization, and so we are investing in companies that could be truly disruptive and sort of moonshots versus incremental. So I'd say we sort of straddle both across our portfolio.
Terrific. Thanks, Ben. So let me pose a question for the panel and get some thoughts from you all. Some of you may have seen CEVG released a white paper, which, if you haven't seen it, it's called Clean Tech 3.0. To the extent folks were on the webinar yesterday, they discussed it. But I would call it an optimistic counterpoint to the MIT paper that came out back in 2016, which sort of bemoaned the fact that there were abysmal track record and returns on the significant amounts of capital that were invested in clean tech in the early part of this decade. So we've seen, you know, this kind of boom and bust cycle in other industries beyond clean tech. And my personal view is that, you know, all industries, regardless of their growth potential, have elements of cyclicality. So I'd like to hear from the panelists on their view of, you know, where we are in the clean tech cycle, and to what extent does the capital that was invested in the, you know, previous decade, to what extent is that impacting, you know, good or bad, the ability to find attractive investments and raise capital in the current cycle? So Sasha, can I ask you to comment on that?
So starting with the end of your question first, I think it doesn't impact at all the ability to find good deals. I think there are more good things to do than capital out there to do them. It does definitely impact raising capital. There's the first wave or waves of clean tech, where I think there were a number of problems. Probably the way that I would summarize it is you had a lot of capital that came out of the dot-com boom, and it saw clean tech as the next big thing and applied a lot of, I think, erroneous assumptions about the similarity between the two opportunities and problems. And so you had investors who were not necessarily market experts putting a lot of capital into disruptive technologies that were going to require a tremendous amount of capital to develop, and where there were there were potentially cheaper, better alternatives coming down the pike from China, for example, in one sort of notable case. But what's happened now is clean tech has become basically a dirty word with most LPs, and I think for us it's not necessarily a good description of what we do. We think sustainability more broadly captures how we see the world, which is specific to us, and others may still want and think the clean tech label is appropriate. But we have to be very careful to describe our approach and why it makes sense, why it is not going to fall into the same problems that the earlier waves fell into. And the fact that at the end of the day, if you think about what we do, we're looking at large trends and trying to be smart about where is the market going, what are the solutions that are going to make more and more sense as time goes on, and how does that, you know, as a secondary benefit impact sustainability positively. And that when you put all that together, really it's just prudent investing. And so I think that there's a tension between kind of trying to explain to investors in our fund that at the end of the day they're investing in a solid venture capital strategy that makes top tier returns in a truly risk mitigated way, and at the same time, you know, being seen inevitably as impact investors, and that's somehow different from a traditional venture capital fund. And we all care very deeply about the issues, but we think having top tier financial returns is the way that those issues are ultimately promoted, and we get the best leverage from an impact perspective in what we do.
So I do have, it looks like we've got a question from the interwebs, which is around what are the targeted returns that a fund such as yours looks for?
So at our stage, you generally see claims of anything from 20 to 40%. In our fund one, we are very close to the higher end of that range, and we are that's a 2011 vintage fund, and we're the number one ranked fund by DPI, not impact fund, but VC fund overall for 2011, according to Cambridge. I think if you can exceed 20% reliably, those are darn good returns. And that's going to be different though, you know, as a caveat, perhaps obvious, that if you're a super early stage investor versus a much later stage, something closer to structured equity, your risk profile is different. So as you get more structured, more risk mitigated, those returns go down, but the presumption is that the odds that there's ever any variability there are a lot lower. So that's us, and kind of how that would scale on either end of the risk reward spectrum.
Thanks, Sasha. I want to come back to the question that I just posed around the previous cycle and this cycle, and see if Ryan have any comments on that. And I'm just curious, from your perspectives, to what extent does the capital that was spent in the last cycle, is it gone forever, or is it benefiting us today? You want to comment?
Sure. So I would say a couple of things have come out of the sort of previous cycle. I think we've got the benefit of a lot of technology gains that maybe returns weren't necessarily realized on, but value was created. And I'll touch on why I think that is. But you've seen the cost curve of batteries and solar technology coming down drastically. You know, those were some people would argue inevitable cost curves, but they were really catalyzed by a lot of investment, 8 to 10 years ago. And now you're seeing more capital efficient models coming out that's leveraging that technology in unique ways to create value, and I think that's great. The other thing that's come out of that is, I think entrepreneurs and other financial investors that are investing in the energy space have recognized that it's a very slow-moving, risk-averse industry, and it's really hard to do it on your own. And so you're seeing a lot more corporate money, industrials coming into the sector with venture groups like us at GE that are investing in these companies at early stages, but also partnering and adding value. So they're not going in on their own. They're not raising $300, $500 million before they've even proven a technology to scale up so that they can compete. They're leveraging partners where they can. They're being smart about the capital that they bring into the companies. And I think those are lessons that were sort of hard learned, the last decade.
Excellent. Thanks very much, Ben. So Ryan, I'll pose this question for you. So, my sense of the foundation world is in the past, foundations invested through their endowments, who then invested in managers, who then put money into, whatever they put money into, clean tech or whatever other sector. And, for those of you, it may not have come across, but, Ryan made this point, and it took me a few times to get it. Prime has done something quite unique, which is they're tapping into a stream of investment dollars, which is the programmatic side of foundation investments, as well as the endowment side. So this is a pretty nascent effort at this point, but I'm curious, Ryan, if you could comment on, to the extent to which this has been tried before, and how you guys see this shift evolving and perhaps growing as we move forward.
Yeah, of course. Thanks, John. The vehicle of a program-related investment, it's not actually that new, right? It's been around for a while. It's just it requires quite a sophisticated fund manager at a private foundation to be able to figure out all the IRS guidelines to be able to do it and do it within those restrictions, and to do it to make sure that it upholds the mission that the foundation's established to uphold. In Prime's perspective, we're hyper-focused on this climate mitigation issue, but certainly believe that you can mobilize philanthropic capital through program-related investments at a private foundation or other direct investment mechanics at a donor-advised fund for a number of different types of social issues. Any of the UN Sustainable Development Goals can be supported using philanthropic capital. It would require, to make sure that we're thinking about things, from an academic standpoint, to be rigorous and ensure the governance structures all make sense. But we do think that this is a model that can be duplicated across many different types of sectors. In that regard, we try to be as transparent as possible about what we've done and what we've learned throughout this process so that others can mirror it. And so if there's anybody that's interested in trying to take this to climate adaptation or energy access or poverty alleviation or education, we certainly believe that there's opportunities to do that, and we'd love to partner along that journey.
Terrific. Thanks very much, Ryan. So Ben, I'm going to move back to you, and as a giant industrial conglomerate investing in early stage and partnering with early stage companies, I wonder if you could describe for the entrepreneurs in the audience, what is it like partnering with a large company? What are the pluses and minuses from the entrepreneur's point of view? And what role does the kind of financial side of GE, the group that you represent, play versus, say, a business unit who might have a partner or customer role?
Yeah, in two quick words, the plus is scale and the minus is speed. So we're, what we lack for speed, we make up in mass and ultimately get momentum. But I think we've done partnerships with our portfolio companies that are go-to-market partnerships that have worked very well. We've done some technology development partnerships. Those have been successful as well. We have instances where GE is a customer of a portfolio company or vice versa. Those have all, different shapes and sizes have all worked well structurally. I think, us within GE Ventures, we are investors. We are a separate group outside of the business units. We look at our companies and take active investment roles. We're in the board conversations. We need to think for the company what's best for the company. We've got a responsibility to do that. And sometimes partnering with a big company is not the right choice, and especially if it's contemplating some sort of exclusivity in the early days of a company. So we do balance that. We treat the partnership side of a relationship with a portfolio company separate from the investment side. As investors, we certainly help bridge that gap. But in terms of execution, the business units run the partnership. We run the investment side. We don't mix and mingle. There's certain, we've got confidentiality responsibilities as investors that we can't share with the business unit. So it is, it can be very valuable. I think you have to be smart about who you partner with, making sure that everyone is on the same page in terms of incentives and expectations is really important upfront. And then thinking about what you potentially lose from partnering with someone, as it relates to other partnerships that you may want to do.
Thanks very much, Ben. So Sasha, I want to come back to your slides, and you skipped over, in the interest of time, a little bit of a discussion around what you called a systems approach. But that's an interesting and kind of different strategy, at least by conventional standards. So I wonder if you could comment a little bit more. Just what does that mean? What is a systems approach, and maybe give us an example.
Sure. So I think boiling it down to its essence, it's really about looking at what the system, that's the market, the business system, natural resource constraints, what all of that says about what opportunities there should be for businesses to innovate. And so it's a market focused as opposed to technology focused sort of research process as we figure out where we want to allocate our time and our capital. And so we are first figuring out where is the system ready to change, and then we are looking for the solution set of technologies and business model innovations that are ready to fill those needs. So perhaps using an example in our portfolio that's the least obvious, I suspect from an impact perspective, we invested in Fund 1 in a probiotic beverage called KeVita. And I think a lot of folks look at that and say, how the heck is that an impact investment? But if you think about it from a systems perspective, we're very interested in agriculture. There's a ton of monocropping, a lot of nasty pesticides and destructive practices used to farm a tremendous amount of corn in this country. And the need for that corn is questionable. I won't go totally sideways on the way the subsidies are structured, but at the end of the day, the American consumer eats a ton of high fructose corn syrup, and it's not good for health, and it leads to a bunch of waste in the healthcare system. But consumers desire high fructose corn syrup in their beverages. We drink a ton of soda, and if from what we saw was increasing consumer demand starting in the natural segment for healthier products, including, beverages that are less sugary, that don't have high fructose corn syrup, and that starts from naked juice and POM and things like that, and it started to work its way towards kind of wackier stuff like kombucha. And the thought there is, if consumers increasingly demand that corn syrup is taken out of their beverages, that's a huge impact on both agriculture and health and the waste that comes with that. So the systems perspective led us to this place where we're looking at a consumer product that we think has a tremendous impact in the long term. In the short term, it's not, this is the difference between kind of the moonshot and the incremental approach. No, it's not tomorrow going to impact climate change. But we think that in the longer term, this shift in consumer recording it with beverages that, unlike kombucha, which has uncontrolled fermentation, and so you end up with too much alcohol, too much sugar compared to what you're advertising to consumers, you have a product that makes sense, that appeals to broad consumer tastes, and that ultimately Pepsi purchased out of our portfolio and plans to deploy pretty widely, and now is in not just the natural segment, but conventional grocery store. So starting with kind of the hardest example first, that's kind of the difference between what does a systems approach lead you to versus let's go out and find cool technologies and figure out where they then could possibly change markets.
Terrific, thanks, Sasha. So I want to sort of ask a question around the thesis of this, or the main question that was raised in this webinar itself, which is new investment models. And maybe I'll start off the discussion by, mentioning one that I've seen and that we're active in investing in. So, the traditional venture model of capital goes into a company, and, companies grow and raise subsequent rounds of capital and then find an exit. We are seeing a lot of interest and a lot of applicability of a model that sort of combines debt and equity financing, even for early stage companies. Now, in say, I'm an investor in something called Sealed, which is an efficiency finance company here that got spawned out of Acre. It's not surprising that, they would combine debt and equity because other financial projects in the past have used debt to finance the kinds of upgrades that Sealed is funding. But one of the new models we're seeing is that even in cases of sort of more industrial companies selling pieces of equipment, there's a movement towards selling services, right? Which might be lighting, it might be electricity generation, and that in some cases is changing the way an equipment provider might otherwise sell widgets of one sort or another. So I wonder if anybody on the panelists can comment on similar evolutions in business models that they're seeing along that line or otherwise. Anybody want to go first?
So I think the way that we see most frequently kind of the as a service business model and the investment models changing, impacting us is not necessarily something that looks more like debt competing with our sort of flavor of capital, but in support of those, I mean, I think the reason you see more of those kind of as a service business models is from a customer perspective, you're not requiring a significant amount of CapEx upfront. You're allowing them to pay for something over time, which generally is an easier sell and customers like. The thing that has enabled that in a lot of cases is asset investors who are willing to take a look at something that doesn't look like, you know, the things they've done 1,000 times before. So when, you know, one of the really important things that Solar City did was to provide financing for all their customers, which enabled then a lot of more traditional financing providers to say, hey, it turns out this solar stuff is legit and there's a long track record, and we can now look at a portfolio and start providing project level capital. And that works really well for the equity level investors, and we're seeing that in more and more markets like the ones you brought up, energy efficiency, and a variety of others. So I think for there are obvious customer reasons why that happens, and from an equity perspective, it's very useful to have innovation in other parts of the capital stack, because often that's enabling for the companies that we're investing in and helps them accelerate their growth using less of the expensive, arguably inappropriate kind of equity capital for project level work.
Terrific, thanks. Thanks, Sasha. Actually, we're getting a question here on the interwebs, which is around which of the people represented here today invest seed capital, and what is the dollar amount? I think we heard, Ben, you say that your sweet spot is kind of Series B and later. Ryan, I think you clearly said that you guys will invest seed as well as later stage capital.
Yeah, as long as it's a fit for charitable capital, we really can participate in any round, but that justification becomes harder and harder the later you are in the company's growth. So our sweet spot would definitely be in the seed to Series A round, typically on the order of $500,000 to $3 million, but that can kind of fluctuate a little bit though.
And I would say for myself and in the CEVG context, I think you see rounds there that are single digit tens of thousands of dollars at the very earliest stages to, in the single digit millions of dollars for later stage deals. The question also came through, talking about whether the investments are purely equity or equity paired with debt. And I would say that in the appropriate circumstances, equity paired with debt makes sense. I don't know that anybody here, maybe with the exception of GE, has an in-house debt capability. But as Sasha said, there is a lot of interest I've seen from either hedge funds or other sort of non-traditional players who would love to get exposure to assets that they think, have a risk-return profile that is attractive. They can go buy pools of mortgages or car loans or credit cards, and they make, very, very narrow spreads. Those markets are super efficient. But some of the pools of renewable type investments, whether they're solar or efficiency, what I'm seeing is that if you look at the risk and you compare it to some other, established financial asset class, you basically get a much higher return for some of these newer classes. So we are seeing a lot of interest on the part of these non-traditional investors in partnering up with quite early stage companies to provide debt capital. So let me change the topic a little bit and ask a question for the group. Something that I've spent a lot of time thinking about and looking for investments in are situations which leverage data. And clearly Google and Facebook and Amazon, have established that, data is a huge driver of their businesses. And to a certain extent, it's sort of game over in advertising and retail, I feel. But for the rest of the group here, what are you seeing in your companies in terms of capturing or leveraging data in new ways that, might help advance clean tech? Anybody want to go first?
So we see data being an important part as more energy assets become more distributed and smaller. There's massive opportunity to leverage distributed generation, distributed storage, and distributed load to optimize the existing network that is the electricity grid. To do that, you have to, one, have a model of that grid, and two, understand what's going on in real time. And the real time aspect of it is a combination of data and connectivity and control. But almost every device, no matter what type of device it is today, is sold with connectivity out of the box. So there's just massive amounts of data coming online, and tapping into that in an intelligent and optimized way has huge implications.
Any examples that come to mind?
Company-wise, we have a company that was an investment that GE acquired about a year ago called Bitstu, that was a Vancouver-based company that was a data ingestion technology. So they would take any data set. They were focused in the utility sector originally, and they could ingest that data set and immediately create value from it, from just massive amounts of data that utilities had but weren't leveraging. I think that's sort of the first step in how do you create value out of data. You understand your data. You take it out of spreadsheets and clipboards, and you digitize it, and you create access to it, and then insights from it. Bitstu was a successful example in space.
Terrific. Thanks, Ben. So let me ask a question for the group around geographical focus and the extent to which you're investing in companies that are located here in the U.S., perhaps here in the Northeast, or internationally, and then also the extent to which the companies in which you invest are active, either locally or globally. Sasha, do you want to go first?
Sure. So we have a tremendous amount of interest in investing outside of the U.S., but we struggle internally with how to do that, largely because of our investment style, which is very active, and there is an obvious barrier when a company is halfway around the world with knowing what's going on day to day, being supportive in the right ways, figuring out how we use our experience and our resources to help that company. And as a second barrier, how do we make sure we know those markets well enough that we know what we don't know and we get comfortable with that? So the fact that there is just tremendous opportunity elsewhere is obvious, and we personally struggle with the right way to do that, and would like to figure that out, but have been cautious about doing so for the reasons that I just outlined.
I'll make a comment. This is John Santelleri on NYSERDA's behalf, and I've been struck as I've gotten to know NYSERDA and their touch points and their activities sort of north of New York City, that there is an awful lot of innovation and very high quality research taking place upstate New York, everywhere from Buffalo, Rochester, Syracuse, and Albany, places that are somewhat foreign to investors from Silicon Valley or even Boston or New York City. And certainly, I think there is a dearth of funding right here domestically that we see, and in my experience, it's a great combination to have lots of good things going on with few investors. The multiples that we're seeing companies get funded at are much better than, say, a data security startup or some of the other momentum-y kind of hot areas. So speaking for NYSERDA, they've obviously got a New York State focus, and even CEVG is definitely targeted in the neighborhood, in the Northeast, because of the same reason that Sasha mentioned, which is if you're going to be active supporting your companies and actively engaged, it's difficult to do that unless they're close by.
Upstate New York as emerging market?
I think upstate New York is an emerging market. There's a bunch of trains every day from New York City to Albany, and you can get to you can cover the state very quickly. I heard a comment I've not independently verified it, but I think the source is credible. But if you look at the amount of research dollars that are spent just in upstate New York, it really rivals, kind of the combination of MIT and Stanford, which is quite impressive. So stay tuned for more opportunities there. And I'm personally committed to making sure that CEVG gets exposed to those opportunities. Well, so now it's 2:25, and I think it is time to shift to the second phase of our presentation and webinar here, where we've got 4 startups who are going to do short pitches, and then Shark Tank style, we will give feedback and maybe ask some follow-on questions. And our first...
So John.
Alistair.
Hi, John. Yeah, this is Alistair back. I did get the names. I don't know if you've had the same news, but I could mention the names if that would be helpful.
Please.
Yeah, so happy to welcome Derek Leclerc from Empower Equity, Dan Nadav from EnviroPower, Jean-Marie Bergiard from Meteo Viva, and Jonathan Haas from Thermolift. And I'll hand it back to you, John.
Terrific. So we've got Derek and Herbert here from Empower, and you guys are up first.
Hi, I'm Derek Leclerc. I'm here to talk to you guys today a little bit about how we at Empower Equity plan to bring financial efficiency to energy efficiency. And I want to start off today by talking about 2 very important people. Slide. First is Craig. Craig's the executive director of a long-term care facility called Inspiration Ministries. Now, about a year ago, Craig realized he had a problem. His lights were old. His patrons were complaining about Nope, sorry. Go back. His patrons were complaining about dimly lit rooms and hallways, as well as a parking lot that just wasn't well lit. Furthermore, he knew that he could save a ton of money and do something good for the environment. So he called our second character. Slide. Todd. Todd's an importer of LED light bulbs and also a general contractor. So he's got the goods and the team to solve Craig's problem. So why then did this job sit there for almost a year unbuilt? Well, the answer is pretty simple. Slide. Craig didn't have the money available, and Todd just isn't an expert when it comes to financial solutions. Now, what if I was to tell you that there are thousands of Todds and more than 1 million Craigs? Well, it would follow that slide. The USDOE found that only 12% of commercial buildings in the United States had retrofitted to LEDs. And that's in the lowest hanging fruit of energy efficiency, which is LED. Slide. And that's exactly why Empower Equity created the Unfinancing program, to make financing just as efficient as Todd's light bulbs. Slide. Unfinancing pairs together our proprietary Empower Visibility platform and our innovative Simple Energy subscription to give contractors like Todd the tools that they need to close more deals with their customers like Craig faster. Slide. So how do we make money? Well, there's 3 ways. First, we make an underwriting fee on each project that we originate. Secondly, we are the asset manager of the project after it has been built, so we earn a fee there as well. But most importantly, with every project we originate, we are creating another annuity to drive the value of our company. Because right now, slide, the value of our company is mostly our team. Together, we have over 100 years of experience in energy efficiency and have financially and mechanically evaluated over $300 million of energy efficiency projects, including over 20% of installed CHP under 25 kilowatts in the United States. Slide. So our go-to-market strategy is threefold. First, we're going to continue to partner with companies like Todd's, who offer us anywhere from $2 to $10 million a year in deal flow. But we are also partnering with utilities across the United States and Canada to give us access to tens of thousands of Craigs at once, and also with manufacturers who provide access to dozens, if not hundreds, of Craigs. And I am happy to announce that as of last month, Empower Equity Slide was able to come to an agreement on a strategic alliance with a Fortune 1000 company to bring its unfinancing program to its national network of Todds. And that's largely why we're here today. Slide. We are here to begin the process of raising our $2 million Series A round so that we can continue our growth into 2018 and beyond. The use of funds will be completing the Empower Visibility platform as soon as possible, making several key hires, and business development and market development in our key initial pilot markets. Slide. Thank you very much for your time.
So guys, thank you. We're gonna have to pass this mic back and forth here, but I'll lead off with a question. You know, how many projects have you completed, and how have you financed them to date?
Sorry. So we launched the Unfinancing program just in the summer of this past year with 2 initial partners, including Todd. And so to date, we've built a pipeline in the last 6 months of $2.5 million worth of projects at 23 sites, mostly in Wisconsin and in New York. We signed the first Simple Energy subscription in December of this month, and we have a near-term pipeline of 11 additional projects that we assume to close in the next 6 months or so. Our initial source of funding has been essentially internal capital. However, we also have an agreement in principle with a large debt provider as well. You know, more on that we can take offline. I just don't want to say it right out loud. But that will be offering pretty substantial leverage on projects moving forward.
Derek Herbert, I think I'm a big fan of the narrative and speaking through the problem and how that, you know, you directly have these relationships with your customers and how you're bringing a solution that will address that problem. Can you give me a little bit more context? We saw the slide that showed the dissemination of LEDs and how you're going to look to address that. But can you give us a little bit more of a sense in terms of dollars, what kind of markets you're looking to address here and how big the problem is from a total addressable market standpoint?
Okay, yeah, sure. So as far as a total addressable market, with our Fortune 1000 company or 1000 partner, they've initially committed $20 million in deal flow in the next 24 months. That being said, this is particularly in the boiler and the combined heat and power market. The boiler market in the United States in 2016 was $840 million. It's a relatively stable market. It is expected $1 billion by 2024. The combined heat and power market with natural gas is at all-time lows here in the United States, relatively speaking, is really where we see a tremendous market potential. The total addressable market there in our targeted vertical, which is anywhere from 0 kilowatts to 0.1 kilowatts all the way up to say 500 kilowatts. In our initial verticals, which include hospitals, hotels, industrials, and long-term care facilities. Did I say hotels, long-term care? There's about 40,011 per the DOE, 40,000 sites available in that vertical, and that is an expected total addressable market of about $23 billion. But of course, that's not annualized, that's total addressable. And the LED market is a little bit more difficult to totally pin down. The best thing I can tell you on that is the compound annual growth rate in the LED space via subscription style financing. I believe it was Rocky Mountain Institute stated that between now and 2026, we are looking at a 52.7% compound annual growth rate. So we feel that there's a tremendous opportunity there as well. going forward. And those are our three major verticals. I don't know if that was also part of your question, but we plan to add several more verticals as we move along within energy efficiency, whether it be ground source heat pumps or variable frequency drives. We're open to anything as long as it saves energy and money. Thank you.
So thanks, guys. I think we're ready for our next presenters from EnviroPower Technologies.
I figured this out. Hey, Derek, great meeting you in person finally. Great. So thanks so much for having us. My name is Dan, CEO of EnviroPower. EnviroPower is an early stage company out of Hartford, Connecticut. And based on our patent pending technology, we're rolling these days into the market distributed generation enabled heating systems. In other words, our heating system can play a major role in enabling every home and every business to generate inexpensive electricity, to enjoy full backup power and be part of a larger electric network. And
hey, excuse me, Dan, but this is Alistair. We can barely hear you. So I know that maybe the last speaker was too close, but you're too far away. So happy medium in between, please, and then we can hear you better.
So I'm used to talk to audience with my fairly loud voice. So no, I'll be disciplined.
Thank you.
Yeah, and given today's market dynamics, it makes linking between heating systems and distributed generation and IoTs makes perfect sense. Why? Slide. Because the power grid is changing. There's a major shift from central generation and into distributed generation. And this shift is not occurring because of some successful company out of Connecticut comes to the market with new and cool technologies. This shift is not occurring because some regulators or utilities decided to do so. This shift is happening because of consumer preferences and economic signals. In other words, this shift is real because it makes economic sense to use distributed generation. And this shift also is shaping the utilities of the future. Next slide. With 87% of millennials interested in generating their own power and all major power utilities in New York engage and promote distributed generation programs, this future is already here. Next slide. But this future does not come without challenges. One of the major challenges of distributed generation today, that except for solar PV, no other on-site power generation technologies in today's markets for home and businesses is either scalable or affordable. Sometimes the technologies are just too expensive. Some other times you need to set a whole new sales channel, which is very expensive and hard to do. So how are we different? How is EnviroPower overcoming this challenge? Our distributed generation technology is designed to substitute a product that exists in every home and every business. Next slide. Our SmartWatt boiler is the next generation heating system. There are 4.5 heating systems sold in the United States every year. It's a non-discretionary product. Everyone needs heat. Everyone has a heating system. And when your heating system fails, rest assured you'll have a new one the next day. And at this point, we will be able to provide you the SmartWatt boiler, an affordable heating system that, while producing heat, operates as a distributed generation technology, generating inexpensive on-site power. Thank you.
Terrific. Thanks very much, Dan. So, who's got a question for Dan?
Can you talk about the unit economics for one of your products, and to the extent that that relies on utility participation in a DG program, what assumptions you make about how that supplements?
So I like to compare ourselves to solar because it's a big industry, and we believe it can be even a bigger industry using this technology or similar technologies. So what's unique about this technology as opposed to other who tried to do that before, we are truly a boiler. We started actually by designing a boiler, and then we ask how we integrate into the boiler geometry or the heating system geometry a generator that does not disturb its functionality, and more importantly, does not impact its price. So I'll give you the price. Right now, you can buy a large boiler for your home or a boiler that will satisfy the entire hot water needs for a 50 apartment building for $9,000. Obviously, there's some premium over another boiler. A similar boiler with a similar boiler that just do that, making heat and not electricity, costs $6,000. It's $3,000 premium. At your home, you'll cover this premium within 3 years. In an apartment building, you'll cover this premium within half a year.
What assumptions go into that time frame? Sure.
The question was about the economic of the system and what assumptions we're making based on the answer. So basically, we're just taking what's called the spark spread, the difference between kilowatt hour of gas, kilowatt hour of electricity. Connecticut is the highest in the country, and New York is coming 5th. And so you're paying for your gas around 3 cents per kilowatt hour if you live in New York, and you're probably paying 20 cents per kilowatt hour of electricity. And that gap creates a huge amount of saving potentially for the consumers. We haven't started talking about having a distributed generation that is fully dispatchable, what it can make for the utilities in controlling the peak load and lowering it down.
I'm going to take the liberty of one more question. I think you mentioned this in your deck, but natural gas versus propane, how does the payback change?
So propane is obviously more expensive. We have a customer that is using propane. It's actually, maybe even in this slide deck, they are saving $60 to $100 every year by deploying our boiler. But think about it, this is a classic example. They need to replace their old boiler anyway. And so they had to choose between a $17,000 project with a regular boiler and a $20,000 project with our boiler with a $60 to $100 in savings every year. I think it's fierce.
Great. When can I get one for my place in Connecticut? Actually, we will talk after this, but we need to shift now to Medio Viva. Dan, thanks very much from EnviroPower, and now we've got Medio Viva coming up.
I have to try to speak in this thing, right, so that everybody hears me. My name is Jean-Marie Berjal. I lead Medio Viva's efforts in the US. Medio Viva is a young German company in the efficiency business, the HVAC energy efficiency business, which we sell as a service. Slide, yes, thank you. So the punchline, small initial investments, $50,000 to $150,000, big savings. 20% is what we have achieved across the first 65 buildings that we have in Europe. We follow a shared savings model where we tell our customers, once you've paid this initial investment, which by the way we can finance, we will charge you a third of the savings. And to this date, we have over 70 buildings under management. Since 2007, when we started business, we have not lost a single customer. And every single one of these contracts is actually cancelable with no penalty at any time. We have happy customers. Next slide. The core of the technology is really the driving of the HVAC system using a model. So we will model the building from a thermodynamic standpoint and factor all the elements that will impact climate, from the weather forecast, including solar radiation, of course, wind and so on and so forth, the physics of the building, energy prices, very important, to then optimize the way we are going to drive the equipment. At the end of the day, we are going to send so-called set points to the equipment to start the chiller at the right time, of the optimum time, which could be today, then tomorrow, and so on and so forth. Next slide. With the model, we can do all sorts of things. Because we slice time in 15-minute increments, you can actually add some constraints which allow you to easily implement things like automated demand response, easily implement variable or time-based electricity pricing, manage peak load, forecast your energy consumption, particularly focus on the HVAC, of course. I'm not talking about elevators or lighting. And expanding beyond the control of a single building or the optimization of a single building, you can actually widen your perimeter to a campus, whether it's an airport or university or just multiple buildings that happen to be in the same area, and start to campus level optimization, incorporating the storage of energy, whether it is thermal or electric, as well as production of energy, whether it's solar and wind. Just to conclude, we have happy customers. The parent company in Germany is pretty much cash flow positive. We're still investing in getting this technology known, our biggest hurdle being the fact that nobody understands the fact that good software can actually generate savings. Thank you.
Terrific. Stay close. We'll have some questions for you. I'm going to turn to this end of the room and pass it down.
So I think there's a lot of low-hanging fruit here in terms of optimizing buildings, but there's a bunch of different stakeholders in your customers. There's facilities that just cares about operating the building, making sure things are working. There's sometimes an energy manager that's thinking about energy spend. Sometimes there's a sustainability manager that's thinking about overall sustainability picture, which obviously you help address. There's also the occupants, and all they care about is comfort and productivity. And a lot of the reasons that buildings operate inefficiently is because when I go into a room, I want it to be the temperature that I want it to be. And the only way to make sure it's that way is if we heat the entire floor, because we don't know when I'm going to walk into that room. So my question is, what other building operations are you integrating with to make sure that the building is operating efficiently from an energy standpoint, but operating optimally from a occupant comfort and overall occupant standpoint?
That's a complex topic, but our third bullet is definitely comfort, and I'll give you the punchline, which is that the European Central Bank is one of our clients in Frankfurt. It's a 2+ million square foot building, and when we started the dialogue with them, they told us that they had a ticket system for the tracking, the fixing of the too hot, too cold kind of calls into the facilities group. And we told them, since you have a 200 euro price tag on each of these tickets, we want to be paid on the reduction of the number of the tickets. About 3 months ago, we received our first check. As a side comment though, the issue of comfort is very complex because two people sitting next to each other may not report the same thing. That is very not uncommon, but the model actually has a whole feedback mechanism, which is data driven, of course. But if, subjectively people say, well, it is not quite, what we would like, or the facilities folks, we can actually incorporate that in the model and adjust accordingly.
Do we have time for one more question? Anybody? Go back to your revenue model. I mean, you just gave an example of something that sounded very interesting, but you described something getting paid on a per ticket basis. What are the other? Is that the revenue model across all your sales? And if not, what is the other revenue models?
No, the core one is a shared savings model. We receive a third of the savings achieved by the customer. So there is an installation cost, which again can be financed, but let's assume the customer has actually paid for the installation of the technology. Going forward, we actually receive a third of the savings.
Measure it and audit it?
Yes. Well, so far we have done it ourselves. The first building we did in the US, it so happens, in Washington, it so happens that the District of Columbia SCU, DCSU, actually got involved and audited our analysis. And they actually agreed with the results and decided after the fact to support the project. So from a 36% savings, 1 year payback, this became 36% savings and an obscene payback. But yes, the methodology is completely transparent, is actually part of the contract. Let me just mention some of the clients we have aside from the ECB, BMW, Daimler, Generali, DHL. The car manufacturers are very engineering oriented. These are people that will not let you get away with any kind of fudging the numbers. I can promise you that.
Terrific. Thank you much. Would love to ask more questions, but I want to move on to Jonathan Haas, who's here from Thermolift. Jonathan.
Thank you. So I'm Jonathan Haas. I'm with Thermolift, and we are developing what we think is the world's most efficient heating, cooling, and hot water system. We call it the TC Cycle heat pump. Next slide, please. So the TC Cycle system offers many advantages over traditional or conventional equipment. For one, it offers a 30-50% reduction in energy, which reduces consumer cost for HVAC purposes, and as well as results in greenhouse gas emission reductions. It's one appliance, heating, cooling, and hot water in one system. So instead of going into a basement in most buildings where you'll find big bulky systems usually make a lot of noise, you'll find just one smaller system. It's cold climate capable, meaning that it's able to operate in temperatures below 32 degrees. Most traditional or most heat pumps can't do that because as it gets colder, the electricity that it uses needs to be used for defrosting, and it ends up being not working so well. There's no compressors, no refrigerants. It's natural gas driven, and it could also run on biofuels, JP8, for military purposes. Also possible to use it for solar, concentrated solar. Right now, we're building a system that's going to have a heating capacity of 85,000 BTUs and cooling of 3.5 tons, which is about the capacity of a standard 2,500 square foot building. And as you can see, 45 inches high by 20 inches square. Next slide, please. So in total, we've raised over $15 million. This includes grants from the Department of Energy, NYSERDA, Wells Fargo, and New York State. We also have our primary investors, Topspin and Long Island Angels. So we have, over the years since we were established at the end of 2012, accumulated a lot of support and also formulated a lot of relationships with strategic partners and utilities. This includes National Grid, Con Edison. A group called Linamar is going to be helping us in manufacturing in later stages. They're a $6 billion company. And GTI is also going to be helping us with component optimization. So in total, we have a lot of support, and we're also going to be utilizing utilities to get to the customers. They have a lot of access, and we could really benefit from that. Also, we've accumulated a large patent portfolio of 18 patent families. 6 patents have been issued, and we're continuously expanding that. Next slide, please. So just a really quick overview of where we're at in terms of developing our product. Again, we were established in 2012. Since that time, we've made 3 generations, or should I say we've completed the build testing of 2 generations, are actually about to complete the build of the 3rd generation system right now. This system will be field tested, and then we're going to probably be able to install some units by the end of next year. So once again, I'm Jonathan Haas. If you have any questions, let me know.
Jonathan, thank you. I'll lead off with a question, which is talk a little bit about the target market. I mean, one of the challenges in the retrofit business is that you need to kind of find a customer either when they're doing a new build or, you know, when they've thought carefully about an upgrade. And, you know, particularly at the residential side, so many of these upgrades happen on an emergency basis that you're sort of stuck in this, you know, status quo and non-upgrading. So talk a little bit about the customer target, the value, and, you know, the reason why a customer might buy this, and then how you address the, you know, that upgrade cycle stickiness that I talked about.
Yeah, thanks. That's actually a really good question. So we're targeting both the commercial and residential markets, but we think the lowest hanging fruit is in the commercial market, just because we could target a convenience store, 7-Eleven, or a fast food restaurant and gain a lot of sales just by reaching one customer. And they also probably would see the quickest payback for our system, which we estimate to be around 2 to 3 years. But in terms of where do we get first, new construction is a no-brainer. Again, that's also the lowest hanging fruit, just because when you go to let's say you're building a new home, you have to install a heating, cooling, and hot water system anyway. So instead of installing 3 separate systems, you install ours at a fraction of the cost, and it's more efficient than those systems. And that's going to be a huge value. And in cold climates, that's where we'll really see the biggest benefit, as our system is able to operate as a heat pump in cold climate temperatures, which again is not really not like anything that's out there right now.
Thanks.
Thanks, Jonathan. Just kind of build off that question. I think, you know, starting new construction makes sense, but that market is certainly dwarfed by the retrofit market, especially in the commercial sector. And then when you start to think about agency issues that come up in the commercial sector, whereas many of these are operating off a lessor or lessee agreement, those who are paying for these upfront improvements don't necessarily see the reaped benefits of those savings over time. Have you begun to think about that, and have you had any customer engagements around like how do you actually get this sold in that sort of environment?
Yeah, also a really good question. So the commercial market, I'm sorry, the new construction market is although it's definitely dwarfed by the retrofit, but it's still pretty big. I mean, in the U.S., there's I think around 600 to 700,000 new housing starts per year. That's just in the U.S. I mean, you look at all Europe or other areas, Canada, you add all those up, and you have a large amount of sales. But in general, our to-market strategy is, as I touched upon during the presentation, but we're really going to be trying to continue to develop our relationships with utilities. They have they're usually or their installer networks who they're connected to are usually the first people that are called when there's a problem with a heating or cooling system. And as was mentioned in a previous presentation, that system is fixed or replaced the next day almost, just because it's such a large installer network. And so really it's utilize utilities, continue to form relationships to utilities to reach the installer networks and sort of get the word out of our system, and then see what the market can do from there.
I'm going to close it out. We're just about out of time, but Jonathan, one final question. Building off that commentary, to what extent is a leasing model part of your equation versus a sale of a piece of equipment?
Yeah, that's a really good question. We haven't put that much thought into leasing, although that's really the leasing model, or as you had mentioned earlier, what you're doing with sealed. That is, I think it's a fairly new model, especially with equipment like heating or cooling equipment. It's something that it's sort of in earshot, but we haven't given it that much thought. Right now, we're just focusing on our sales model, which we're going to be pricing the system at around $5,500 to $6,500. So it's pretty palatable. So
terrific. Thanks, Jonathan of Thermolift. So Alistair, with that, we're just about up against the 3 o'clock completion time. So if you have some closing comments, I'll turn it back to you for those.
That's great, John. Thank you so much, and I really appreciate you stepping in to moderate and managing the whole process today, finishing on time. So congratulations. So I would like just to thank everyone who participated today, including our speakers, Ben Sampson from D Ventures, Brian McPherson from Prime, and Sasha Brown from the Ecosystem Integrity Fund. Plus entrepreneurs who just spoke, Derek, Dan, Jean-Marie, and Jonathan, thank you. Thanks also to Katerina, my colleague who organized this whole event, and to our volunteers, Francesco and Ricky, who were there today, making sure everything ran smoothly. And finally, again, thanks to the Urban Future Lab for hosting us today. I'd love to hear how it went. It's been great listening, but I'd love to hear how it felt down there too. And thanks to our sponsors once again, the Massachusetts Clean Energy Center and NYSERDA. So as a reminder, we did record this webinar. We'll be sending that around to everyone who was registered and who attended. That'll be posted on our YouTube channel, but you'll get an email with that. And with that, I will wish you a very happy holiday and hope that you also join us for our next webinar, final webinar in the series on Friday, at 1:30. Yeah, again, I think it's at 1:30, maybe 1 o'clock. We'll clarify that one. But you'll be able to find all of those webinars up there on our YouTube channel if you're not able to join us. So thank you again, and have a great networking session down there at the Urban Future Lab in Brooklyn.
And I'll just mention, Katerina is telling us that on Friday they are starting at 1 p.m.
Yeah, okay. Thanks, Katerina.
Thanks, everyone, and we'll sign off.
Okay, thanks. Bye now.